Welcome back. It's time now for Three Stock Lunch. We're trading some of the big movers of the day. First up, you've got Walgreens Boots Alliance, Dow component, higher despite reporting disappointing fourth quarter earnings and soft guidance this morning as the street seems to like its cost-cutting measures and plans to use AI to streamline its supply chain. So here with our trades this afternoon is David Wagner, portfolio manager over at Aptus Capital Advisors. Walgreens is an interesting fundamental story. New CEO coming in. What's the trade there?
Yeah, I kind of agree with you, Dom, on the CEO news. I think the market should take that very well. I mean, Wentworth has a history of execution, especially on the healthcare services side of the business. I mean, here, everyone knows that the pharmacy side sucks. The retail side also sucks. But it appears that all conversations around Walgreens Boots Alliance right now is actually going to be coming from the healthcare services side of the business. And I mean, if you really focus on this healthcare service side of the business, they've lost almost $600 million year to date off of poor strategy execution. It's like the opposite of the field of dreams. You know, they built these Village MD facilities, but really no one really came. So I'm really not interested in owning a business that has, struggling on the retail side and on the pharmacy side, combined with a third leg of the business really that has had really poor execution on the services side. So I'm staying away here.
All right, let's see what you think about Target, Dave. Higher on an upgrade to buy at B of A. They're saying the shares, which we know have been under a lot of pressure, now look attractive while margins could improve in the year ahead. Would you be a buyer?
Kelly, I'm begrudgingly going to say that it's time that investors can finally start dipping their toes in this name. I'm not going to go to the extent and out on a limb say that the all clear sign is out there. I mean, the stock's still down 25% year to date and down like 20% since July. But, I tell my clients that valuation should never be the sole reason to be bullish on some type of name. I tell them that you need some type of catalyst to drive mean reversion in that valuation. And Kelly, I think that we're finally in an environment where, yes, valuation is very depressed, but you're starting to finally see a few catalysts right now with overall foot traffic moving forward and margins, especially as they have a lot of anniversaries on a lot of bad data. But of course, the wild card here is going to continue to be shrink and its effect on margins. But yeah, Kelly, I'm getting a little bit more constructive here, especially as you've started to see the $3 billion in gross cost savings really start to come to fruition.
All right, and our final name today is Carvana. It's down about 12% on a downgrade over at BNP Paribas, the bank moving to neutral after a monster run for the stock, up 600% or so year to date. Is Carvana now a little too rich?
Yeah, Tom, the downgrade today should not be a huge surprise really for everyone. As you said, the stock's up 600% year to date off of better than expected EBITDA and a debt restructuring that really just kicked the can down the road. Yet there remains an affordability issue here for consumers, coupled with the fact that car prices are going to continue to probably increase due to tighter supply and UAW strikes. Not to mention, Carvana's losing like low double-digit market share right now since they really started to pull back on a lot of their marketing spend and slowed their purchasing of cars. It's a classic catch-22 here. I apologize. They've done a great job keeping cost controls tight, allowing for break-even EBITDAs, but that's baked in right now. Basically for this story to change, they need to persuade investors that they are back again to being a growth stock and not a turnaround story.
All right. David Wagner at Aptus with our Three Stock Lunch today. Thank you very much, sir. We'll see you soon.